This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 66 was recorded on October 7th, 2019. I'm Eric Townsend. Juliette Declercq, founder of JDI Research, is back with us. Juliette, you just released a new report entitled It's Break or Bounce Following the Bend. Now, I'm assuming that you're referring to the global economy. Obviously, I understand that you're going to want to keep the bulk of your thoughts private for your clients, but can you give us at least a glimpse into your current thinking? What are we looking for as far as the global economy is concerned?
Hi, Eric. So it's always a pleasure to be back with you. So I think it's fair to say that my tactically pro-cyclical view has been challenged last week. We are finally receiving crystal clear evidence of a global slowdown in manufacturing, which is also now spreading to some extent to the services sector. Bear in mind, though, this is a theme we have been effectively trading all year long. So going forward, a successful investment process will necessitate to get the post-bend right. The slowdown itself is old news. It's become very easy to flog an apocalyptic scenario with dramatic, eye-catching headlines and charts. So, for example, I've seen one chart doing the round from a bank that I will not name here of SPX year-on-year performance juxtaposed on the new export order component of ISM manufacturing. Now, this is frightening. It supposedly implies a minus 30% year-on-year SPX performance. I mean, come on. Of course, there is a high correlation between one and the other because global activity and trade normally move in lockstep, with trade easier to track in almost real time. But that doesn't mean that a collapse in trade due to an exogenous shock implies a collapse in activity. And especially not in the US, where exports only account for 12% of GDP. So really what I want to warn your listeners about today is to be careful of not confusing correlation and causation, especially when considering extraordinary times and geopolitical shocks, which is what we are seeing now.
Okay, fair point on correlation and causation, but last week's data were pretty atrocious, weren't they?
Yeah, and I've been eagerly awaiting the latest PMI releases. But truthfully, I have not been as disappointed as a consensus thirsty for data confirming a strong recessionary bias would suggest. Survey data remain challenging, to say the least, but really my current tactical cyclical stance is really an appeal to perspective rather than anything else. When I came on Macro Voices last year and explained that it made no sense to extrapolate the strong 2018 growth to infinity, especially due to bearish secular and cyclical forces, what I meant was by secular is weak demographics. And what I meant by cyclical is that nearing full employment, GDP growth becomes constrained to productivity growth, which I think is around a little bit above 1%, and workforce growth, which census expects will be collapsing to 0.5%. So that's about like 1.7% of trend growth in the US. But it is also foolish to extrapolate a predicted 2019 slowdown straight to recession, or at least not without a deeper analysis. I think there's a strong tendency on social media to extrapolate recent trends and use any information to confirm a bias. One thing I have learned over the past 20 years is that when I'm able to display a macro narrative crystal clearly on one chart, it is time to at least consider the other side of the narrative. And that's my message today. It's to warn listeners against trading all news. What we need to know now is whether we break or bounce, and this is the theme of my analysis in this week's JDI report. Going back to the data, this is what I see. So last week, the market global manufacturing PMI saw its first consecutive gain since December 2017. So that's the first two consecutive gains in 18 months. That was spurred by EM Asia. Now, that's interesting because a manufacturing cycle lasts on average 3 years. So 18 months is the average length of a down leg, something really important to bear in mind. As additional positive news, the number of countries in manufacturing decline eased to a 4-month low. Okay, arguably, there was little else to rejoice about because firms' expectations just managed to stabilize and factory headcounts were cut further. But bear in mind, it's always darkest before the dawn. Another thing important to remember is that at such an important juncture, considering data in their granularity is extremely important, and you should look less at headlines, basically. For example, I don't know if you remember earlier this year in Vancouver, I warned that the employment components of the surveys were hiding a much sharper worsening in expectations, simply because employment is a lagging indicator. Now we are seeing headlines collapsing because employment is finally catching up, but leading indicators are actually stabilizing. So it's really important to look at the data in details, not just the headlines.
Juliette, an argument that I hear from quite a few people on this program is, look, the U.S. is, pick your favorite metaphor, the cleanest dirty shirt, the bright spot on a gloomy world. And I guess the question in my mind is, how do you interpret that? Do you interpret that as, okay, the U.S. has better fundamentals and that's going to continue? Or does it mean it's a setup for the U.S. to be the last shoe to drop? And when that shoe does drop, it potentially, it's taking out the last man standing, and then you've got a global recession on your hands and things get maybe worse than 2008?
Well, that's a great question. And in fact, it is the crucial one because the continued global slump was not the real story at all last week. The real story was the death of US exceptionalism. Two things are worth keeping in mind, though. US has been lagging the global cycle because of the pre-tariff inventory builds that we saw last year at the end of 2018. So it's not the best country to analyze if you want to consider green shoots. Also, I want to remind you of something else. Capitalism is a Ponzi scheme. A business cycle relies on employment growth to reach its peak, but once nearing full employment, a slowdown mathematically, and I should say naturally, ensues. It's completely normal at this stage of the US cycle to see payroll gains slow noticeably, and this is what transpired through the employment components of ISM and PMI. Taking these depressing factors into account, my range of estimates for trend employment growth going forward would be, let's say, 70K to 100K new jobs per month. And around these levels, the labor market would still absorb quite easily new entrants and keep unemployment stable. Well, that's exactly what the information we received last week. The claims and employment data showed no signs of firings increasing and actually suggest an economy growing at a subdued 1.5% pace versus the pace implied by ISM and PMI, which would be below 1%. So I think there's a big difference between slower hiring and firings, and that difference is the divide between a continued slowdown and recession. So we have to consider the possibility that the US bends but does not break, and eventually triggering an appropriate reaction from the Fed and a much needed flush of dollar liquidity to the rest of the world. And in that case, global activity could actually spring back up in the process.
Okay, you say global activity could spring back. What makes you think the whole world could spring back? Because frankly, the global growth slowdown has been pretty darn clear.
Yeah, firstly, Chinese PMIs have bottomed. And don't get me wrong, China's health will not benefit the rest of the world as much as in previous liquidity cycles. Because thanks to Trump's raging trade war, China is becoming less and less reliant on exports. So don't forget, the real goal for a country today is a reserve of demand, a reserve of demand that the US doesn't have and Europe doesn't have either. But China has it, and it's naturally moving its economy towards servicing this demand. If you ask me, Trump's trade war is legitimate, but it comes way too late, and there's nothing that will contain China's macroeconomic rise from here. If anything, the Sino-US war is speeding up China's transition. The bottom line is that China will not save us this time, but equally, it will not push the West off the cliff. On the European side, it's more complicated. China's slowdown has certainly weighed on activity, for example, through the auto industry, which is now basically like stagnating, partly due to China. But what is also becoming more and more evident, and that's the reason PMI did not bounce last week in small open economies like Sweden, Belgium, and Switzerland, is that the UK economy is breaking due to Brexit uncertainty. And hard Brexit would cause the EU to break down in sympathy. So we will see how negotiations go into the 31st of October deadline, but I actually see a chance of a deal. Much like the US softened its stance with China when the economy itself softened, it's becoming increasingly evident that Brexit uncertainty is becoming unbearable for both sides of the channel. On the UK side, the game changer with Boris Johnson is that he seems to be holding the rest of the Tory party with a strong hand. So the DUP has lost its kingmaker status and has mellowed down a lot as a consequence. And the ERG, which is the hardline ale of the Tory party, will support an Irish backstop as long as it's sort of like time limited or softened. Meanwhile, the other game changer is that the Labour Party would get crushed at a general election preceding the EU exit, simply because with Brexit the main concern on voters' mind, there's no political space for an undecided party. Well, consequently, there is a chance that a deal could be going through Parliament in October. And this is a game changer for the EU too, because they're suddenly like considering a deal which is highly likely to get voted, as opposed to before when they knew they were negotiating for something that had no chance to go through Parliament. So I think the incentive to compromise is now greater on both sides. Also, let's be frank, Brexit is really seen in Europe as a very British affair, and the rest of Europe would be delighted to put this embarrassing matter behind us, and that's especially true in France. So a disorderly Brexit is still a risk, but I think it's more likely that we would get a general election before. And so the immediate future is possibly brighter.
Well, Juliette, as always, it's absolutely fascinating to talk to you. Wheels in my mind just start going every time we talk. I appreciate that you've got to reserve your specific trade recommendations for your paying subscribers. But may I ask what your general high-level conclusions are market-wise?
Yeah, of course. So exactly, that's a report that I literally released this morning. So I want to keep its direct implications for my clients. But one value-added thought that I would like to leave Macro Voices listeners with is that historically, a combination of pervasive fear and improvement in the second derivative of activity have been a powerful trigger for risk rally. In my process, I call this a risk sweet spot, and that's basically when lagging and coincident data continue deteriorating, which finally fuels bold monetary and fiscal support from literally terror-stricken authorities at a time when a liquidity-driven cycle shows signs of bottoming out. And I think it's time to do really what I want to say is it's time to do your own thorough analysis, not just follow the crowd.
Well, Juliette, I can't thank you enough for another fantastic interview. We look forward to getting you back in a couple of weeks for another update. Listeners, be sure to stay tuned to your Macro Voices feed this week. We've got a terrific All-Stars lineup ahead for you. Louis Vincent Gav is on deck, as are Danielle DiMartino Booth and Jeff Snyder. And, of course, we've got the regular Thursday night flagship podcast as well. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.